How to spot a stock market crash. Warning signs every investor needs to know. Dramatic, slightly anxious music. Hey everyone, and welcome back to Chart Matrix channel. Make sure to subscribe. The idea of a stock market crash can be terrifying. Losing a big chunk of your investments in a short time, nobody wants that. While no one can predict exactly when a crash will happen, history shows us there are often warning signs that appear before a significant downturn. Quick montage of historical crash headlines, e.g., 2008 dot-com bubble, followed by a cautious investor looking at a volatile today. We're going to look at some key indicators and market behaviors that experienced investors watch. This isn't about panic, but about being informed and prepared. Let's dive in. Understanding correction versus crash graphic explaining the difference. Correction equals 10-20% drop. Bear market equals 20% plus drop. Crash equals sudden, sharp, often panic-driven. First, a quick clarification. Correction is a 10-20% drop from a recent peak. These are normal and happen regularly. Bear market is a sustained 20% or more drop. Crash is typically a sudden, sharp, and often panic-driven decline, usually more than 10% in a short period, often leading into a bear market. We're focusing on the signs that could lead to these sharper declines. Warning sign 1. The inverted yield curve graphic showing a normal yield curve, upward slope, versus an inverted yield curve, downward slope. One of the most talked about and historically reliable warning signs is the inverted yield curve. Normally, bonds that mature further in the future offer higher interest rates, yields. This makes sense. You get paid more for tying up your money longer. Chart showing the 10-year versus 2-year Treasury yield spread. Highlight when it goes negative, followed by a recession indicator, but sometimes, the shorter-term bond yields become higher than the longer-term ones. This is an inverted curve. Why does it matter? It signals that bond investors are worried about the short-term future of the economy. They expect things to get bad soon, pushing long-term rates down. Historically, an inverted yield curve has preceded almost every US recession in the last 50 years. Warning sign 2. Excessive valuation and speculation. Another major red flag is when the market gets excessively overvalued and enters a period of high speculation, high valuation. Metrics like the price to earnings ratio * can tell us if stock prices are very high compared to company earnings. If P/E ratios are significantly above historical averages, it suggests stocks might be overpriced. Euphoria and FOMO. Look for signs of irrational exuberance, everyone suddenly talking about getting rich quick, new investors piling into risky assets without understanding them, and a general feeling of FOMO means fear of missing out, driving prices higher. When even your taxi driver is giving stock tips, it might be a sign the top is near. Warning sign 3. Economic slowdown and central bank action icons representing various economic data points. GDP growth slowing, unemployment rising, inflation, central bank meeting. Broader economic trends and central bank responses also play a crucial role. Slowing economy. Look for signs of a slowing economy, declining GDP growth, rising unemployment rates, and weakening consumer spending. Businesses report lower earnings, which impacts stock prices. Aggressive central bank tightening. If a central bank, like the Federal Reserve, is aggressively raising interest rates to combat high inflation, it makes borrowing money more expensive. This can slow down the economy significantly, hitting corporate profits and making stocks less attractive. These actions are often necessary but can sometimes trigger a sharp market correction. Conclusion. Host looking directly at the camera, with channel logo and social media handles displayed. Text overlay. Be prepared, not panicked. So, while no one has a crystal ball, watching indicators like the inverted yield curve, excessive valuations, and a slowing economy combined with aggressive central bank actions can give you a heads up. The goal isn't to predict the exact day, but to be prepared. Diversify your portfolio. Have an emergency fund. Invest for the long term and avoid emotional decisions. And most importantly, keep learning. What other warning signs do you watch for? Let me know in the comments. If you found this helpful, hit that like button, subscribe, and ring the bell. Thanks for watching, and I'll see you next time.